Thank you so much for joining us today. I'm Samantha LaDuc, founder of LaDucTrading.com and also CTO of LaDuc Capital LLC. I am joined by Craig Shapiro. He is hedge fund manager and also our resident macro advisor for our institutional edge and macro advisor bundle product for those who want a macro edge to their trading and investing. As it relates to this market is all macro. We're all rates traders. I just want to let you know that we're coming together once again to kind of do this webinar every other week because the market has been so eventful, and I'm really glad we can do it again. Craig, greetings.
Good afternoon, Samantha. How are you?
I'm good. I'm I like volatility, so it does me fine. But you made a comment today in regards to the Bitcoin volatility. Let's kind of start there because the market has already kind of been on wobbly legs post Fed meeting last week and into and through non-farm payrolls and then midterm elections, and now we've got CPI tomorrow. But we obviously have a big crypto crash going on around us, and you made a comment about collateral damage. Let's kind of start there.
Yeah, I mean, crypto and Bitcoin, the asset class has grown so tremendously, the last decade. And it's obviously gone through, various iterations and ups and downs. And, it's been down a lot, right, this year. And a tremendous amount of market cap has come out of the crypto universe, but it's still a reasonably, big asset class. I mean, in upwards of almost $1 trillion. So it's not, it's not small. And I'll be the first to admit, I've been a kind of Bitcoin bull for a very long time for a variety of different reasons about, fixed supply and, an antidote to paper money and Fed printing. But, it's obviously, that the thesis on Bitcoin has changed its iteration several times over the last, several years. We don't really need to get into it, but as it pertains to right now, well, I mean, really what we're seeing is a massive liquidity squeeze, and some of the biggest players in the world, I mean, most specifically FTX, which is an enormous crypto player, exchange, investor, it seems like they're really going under a lot of pressure. And scramble to raise capital. They're having their own margin call issues. Binance said they would come in and try to provide a lifeline, maybe, but it sounds like that deal is falling apart. And so, because crypto is unregulated, and because these exchanges are unregulated and often overseas, there's just such limited transparency and understanding of kind of how much leverage is in the system behind this exchange in particular, these affiliated companies. And there are a lot of major institutional players that are involved in this space, in this company, and relevant companies. And so you kind of start to unpeel the onion and think about the feedback loop of all the various investors that are in FTX that maybe invested at a $30+ billion valuation less than a year ago, and that the equities were zero. So you start to kind of pile up big losses for maybe some hedge funds, some venture capital firms, some other exchanges that are invested, some private equity firms. You also have these various entities have leverage against those investments. So there are banks who have lent money to these firms to make these kind of investments, and so there's bank exposure. Here there is what I think what might be the most important part of this, which I'm still trying to kind of unwind and figure out, is with respect to stablecoins, because stablecoins, in order to keep their unit value stable, they are invested in the safest securities in the world, most specifically U.S. Treasuries. At times they may be in short-term commercial paper, but it's really U.S. Treasuries that provide the backing for these stablecoins. And not surprisingly, today we had a very significant bond auction, the 10-year auction. It's the biggest, most liquid security in the world. It was probably the worst auction that we've seen in several years. Very poor bid to cover. 3.5 basis point tail, Obviously it's kind of sandwiched between yesterday's election, which we could talk about, and tomorrow's CPI, which we'll talk about. But it was I think Peter Bookbar said it was an atrocious auction. So, look, I mean, if you think about the Fed, you think about the Treasury, they don't want to see disorderly U.S. Treasury markets. I don't think we're in a disorderly U.S. Treasury market yet, but we could get there very rapidly if another buyer of U.S. Treasuries, meaning these stable coins, starts to go away. And so you think about Tether, or you think about Circle, or some of these other larger ones, even FTX's own stable coin or Binance's stable coin, there's a lot of pressure here. So it's not something that I thought was going to be a catalyst per se, but if you were looking for another reason why we may get system deleveraging over the course of the next few weeks, this would be a pretty good culprit. And banks who are looking to kind of clean up their own balance sheets into year end are going to want to get this stuff off the books as rapidly as possible. I mean, the last thing someone like Jamie Dimon wants to hear about or see on his balance sheet is anything related to crypto into year end, as he's trying to get back into his capital charge lower so he could buy back stock next year. And that's for most of the US banks. So we may be in a situation where we get a rapid deleveraging event kind of around these affiliated crypto investments that could lead to other types of deleveraging around the system that may ultimately filter into the Treasury market. So that's what I'm trying to sniff out here.
Okay, so I had just shared a screen while we were talking about the Treasury auction, which coincided, coincidentally enough, with a Nick Tamaros Wall Street Journal tweet regarding some analysts betting on a 6% Fed funds rate because they think inflation control will require the Fed to keep surprising investors by tightening more than markets anticipate. So the new 5% has, 5% has become the new 4%, and now that means that 6% will become the new 5%. But we had talked about this obviously 2 weeks ago, pre-Fed, no pivot, no pivot. So now that's kind of assumed, right? But they keep kind of boiling the frog slowly in water. It just keeps pulling this hole, as you had put it, the further away, which causes risk assets, obviously, to continue to fall, maybe gently and then all at once, or just very slow slog all on the way down. So anything changed since then, since our last kind of talk on no Fed pivot?
Not I would say not specifically, really. The framework that I think I relayed last time, or I know we talked about in the room, has been this idea that the R star for the U.S. economy, the level of interest rate that we kind of allow, slows growth enough to bring inflation down, that still allows for full employment, is materially higher than where we are right now. I mean, we have global, excess savings. We have a generation of homeowners that have 3% mortgages that are really not impacted by these moving rates higher. So, spending has held in okay. GDP in the second half of the year has held in remarkably well. I mean, the Atlanta Fed estimate for 4Q GDP is now up to 4%, which is a 9-month high. So, the U.S. economy can handle a much higher rate regime, and the labor market remains incredibly tight. Wages are still growing, 5, 6, 7%. So it's going to take a lot higher of a terminal rate in order to slow down growth, in order to slow down inflation enough to get back to the Fed's mandate. However, there is another R star. There's actually, in my view, there's two other R stars. There's an R star for the U.S. financial system, the U.S. financial stability, and there's an E, which is lower, right? The U.S. financial system will struggle mightily in a 7% interest rate world, terminal rate world, and a 6% world, and it's already starting to struggle in this kind of 4.5 to 5. The overseas financial stability market will get hurt even quicker than that. And so the question is, at what point do rates rise enough to start to kind of lead to financial stability concerns? So far, the Fed has really said we're not there yet. These markets are operating, are well functioning. Financial stress remains at the lows, according to the St. Louis Fed Financial Stress Index, which various members have continued to talk about. But if we get a backup in yields, and tomorrow, and some more contagion that comes from crypto, and we start to get to a more disorderly U.S. Treasury market, that could be something that causes the Fed to think about pivoting. And we're losing buyers for U.S. Treasuries, right? Overseas buyers are not interested. The Fed is not there. Maybe we're losing stablecoin buyers. And the Treasury is issuing an enormous amount of debt, and has rapidly increased its expectation for the budget deficit for the next 6 months. That came out last week. It's just been a massive pickup in Treasury issuance that's coming over the next 6 months. So who's going to buy all this paper? Is a great question. So if yields start to become disorderly, we may start to see the Fed kind of needing to step back in sooner. We're not there yet, but the more risk off we get, the quicker we get to that point.
So this is just our U.S. debt to the 10-year on a monthly, just to kind of show you this has been a dramatic fall from grace, obviously. But yeah, I still don't see any Fed pivot in this breakage of 40-year channel. This is a ratio chart, but still kind of showing when do we get that effect, like you were just talking about, where the terminal rate starts to really hurt the economy. We're kind of slowly getting there, frog, water, boil. Fed pivot, still don't see it until I get this little level tagged. I showed this a month ago, and it really just hasn't moved. But I think some of the more interesting ones are how SPY, we're all rates traders, so this kind of SPY TNX or Apple TNX and Tesla TNX have been beautiful continuation shorts, for nothing else than because they are really indicating, that's the wrong one, hold on, to see behind the camera. That's NASDAQ to SPX. So we still have, I contend, lots of area on the downside for rates higher and markets lower. I know you're talking about the kind of economic backdrop being a little bit more Goldilocks still, because unemployment is so low, and so far consumers have absorbed the price increases by companies. But there's nothing bullish in this set of charts that I'm showing that still indicates weakness across. And also stronger dollar, but I'm looking for that one. Here it is. That's dollar. Hold on. Give me a second. There it is. Apple to the 10-year. I mean, this is just a solid rollover as rates move higher. So we're already kind of getting that indication in markets. I don't see where I like these charts because it kind of gives me a little bit of a move of where to cover, for example, a Tesla short. And it's not done, right? So this 10-year, for example, on a monthly and a weekly time frame, you can kind of see that it's doing its damage. Rates are moving very firmly, or I should say staying very firm to higher. My rate of change indicator still says it's still got room to go. And the charts themselves kind of prove that market obviously is not the economy, but they continue to come under pressure. Right. So I personally have beliefs about when the market will stop, and it's nowhere near. So you had mentioned let me just get this closed. This as an economic kind of backdrop we're still not there for Fed pivot or pause or even step down. But do you have a particular read for tomorrow's CPI, since there is obviously a lot of inflation baked into that report and its market reaction?
Yeah, I think the setup for this inflation print is different than the one that we saw last time in the middle of October, where markets had been under tremendous pressure kind of leading into that event. And so there was a lot of hedging, there was a lot of puts, there was a lot of downside that had been bought for that event, such that when we got the hotter than expected print, we had the instantaneous fall, and then a put monetization rally that was unlike one we've seen in quite some time, where we saw a several hundred handle S&P rally over the course of the day and the following week and 2 weeks, exacerbated by the BOJ moves and the Nick Timiraos article and the lead up into the Fed. And so we don't really have, today notwithstanding, the setup for tomorrow is not as negative. And I saw there a street survey was going around. 52% of people expect a dovish print tomorrow, and a dovish expectation. I'm just looking here, and a risk on flavor, 30% risk off and 20%, kind of negligible, not too big of a reaction. That is apparently the first CPA survey since June where investors are optimistic. So we do have a situation where people are optimistic about a weaker than expected print tomorrow, such that they had been buying upside calls for the event, or certainly they've been not buying downside protection for tomorrow. There's one of these economic web scraping services called Price Stats, which does a survey of prices, and apparently they're looking for a hotter than expected reading, 0.8 on headline versus 0.6 expected, and 0.5 core. Cleveland Fed is in 0.75 headline and 0.55 core. I mean, look, I think my bias is we're going to get another sticky, strong inflation print that, it doesn't have to be, and in this case, it doesn't have to be a gangbuster print given the setup to lead to a risk off flavor. The market has taken out a lot of 75 basis point hike for December. And so if we got another very aggressive print and crude has remained higher, and then we have Friday, we have the University of Michigan's inflation surveys, which are typically pretty strongly correlated to the price of crude, which is up month over month. So that could come in higher than expected. I think if that happens, you'll get more pricing into the front end again of higher rate hikes, and it will help take the terminal rate back up again. And the terminal rate kind of ended today, at the 505 level for both for May and for June, down off the highs a little bit. But I think another hot inflation print could take us back up towards or take us towards 5.25 or higher. And
Any comment? Go ahead.
No, I think that's the setup for risk, for risk reduction and for risk off, forgetting about all the other stuff we mentioned earlier regarding deleveraging and crypto and other stuff.
Yeah. Any comments on the ISM prices paid that came out?
Yeah, look, I think that it's a good chart you have there. I mean, the issue for markets is the green line. The green line is kind of your core services inflation, which is something that Powell specifically has said he's watching for to see a rollover, because core services inflation is much more directly driven by wages, and wages are much stickier than goods prices, which are more impacted by the inventory cycle and some of the shortages we saw last year, which are being alleviated now. Used cars and supply chain has eased up, so goods inflation has rolled over, but services inflation is really not, and actually with some metrics is reaccelerating, kind of in line with these wage hike, with this wage growth. So I think as long as core services inflation remains robust, it's going to be very hard for the Fed to climb down its tightening path. The labor market is very, very strong still. Yes, we've seen layoffs. Most of those layoffs are high-paying Silicon Valley or maybe financial firm jobs. Those are important jobs, but there is still, major demand across wide swaths of the geography of America, looking for labor in the, $25 to $50 an hour range, the $50,000 to $30,000 to $80,000 a year jobs, and that's where the shortages are. And until people from Silicon Valley decide to pick up a hammer and start doing construction in Southwest Florida, we're going to continue to have this bifurcated labor market. And there's enough Fed presidents who are still kind of hearing this from constituents that the labor market is incredibly tight, And one other point I'd make, I don't think we talked about this last time, is just this idea about long COVID and COVID itself, which has removed an enormous amount of labor from the market. And you think about more disability, more people on disability for longer, is a labor supply issue. And so the New York Fed did a study about this a few weeks ago, and it's showing, in upwards of 5 million people may have been displaced from the labor market due to COVID. Or long COVID. So this is another factor that is keeping wages robust, which keeps the odds of a wage price spiral in front of the Fed's face, which makes it harder for them to pause or pivot. And so, we keep pushing out the timeline for a liquidity add back into markets, which is what I think is needed to firmly get us back to, more of a bull market construction.
So I have up a chart, obviously, of claims on unemployment, and it's just saying that, right? So, and that's been my baseline, as you know, since October 2021, and that, the deflation of wages ended with COVID. So until this kind of burst, which is a momentum burst that lags and then picks up speed, and it's obviously got a look of bottoming, but it certainly hasn't picked up enough to help the Fed make its case. But I also like this chart of new houses for sale by stage of construction, and it's an unemployment kind of graph that looks really, really choppy. But the point is that until this blue line comes back, and through the mean, the zero basically line, houses right now, the backlogs that construction has, they're still playing catch up. So once they do, then there will be some very large construction related layoffs, like happened in Idaho this past week. The largest home builder laid off half of its staff, but that's not the national average right now. So right now it's still coming in, the backlog, if you will, and playing catch up, and lots of need and higher wages are still the enemy of bonds, basically, and Fed. But I think that this will be kind of a little bit more of a timing when this rolls over. We'll start to see a lot more unemployment, not just in that sector, but it's also big. It has 15% impact on the GDP. So just kind of showing those two charts that, yes, I agree with you. That's one of my kind of 5 areas that I'm looking at. Inflation expectations, which yes, can roll over, but we can also have, waves of peaks, of inflation peaks, just very much like the 70s. We really won't know, but that's kind of been my baseline bet. And so right now, the expectation that we peak and come down, not a surprise, but then we still have to, go get through the winter, and very much oil and gas is a weather related bet. Houses under construction, like I mentioned, I think that's definitely once we see the job layoffs in that particular regard. But unemployment on Friday was, a very robust 260,000, especially in leisure, hospitality. So yeah, ISM services, definitely a strong component of the no pivot zone. But now talk a little bit about, Nomura and the Fed terminal rate, and now, Nick from the Wall Street Journal tweeting. We definitely, in my opinion, don't have a market that smells a pivot coming, and China reopening is definitely not my baseline bet. What's your timing for a potential pivot? When would it trigger for you?
Yeah, I think that ultimately the Fed will be forced to pivot for financial stability risks before it is forced to pivot because of its impact on the real economy. And so what we're trying to figure out is where are the fringe points or the fault lines of around the world that will break, that will ultimately lead to this spiral of dollar selling, so dollar rallies because overseas companies or overseas banks or overseas countries need to get access to dollars, so they're selling assets to raise dollars. Dollar rallies, yields move higher because they're selling treasuries, and that doom loop, creates a break somewhere, a failed treasury auction, something in Japan, something in the UK, somewhere, in Switzerland. We talked about a bunch of these areas, the Hong Kong dollar breaks, something like that ultimately will lead to a massive deleveraging event that then takes down inflation expectations. Because ultimately what happens in these deleveraging events is that inflation expectations typically plummet because people are afraid that assets are going to go to zero. And so it'll be that active inflation expectations falling because crude gets hit or across the board assets get hit. That will allow the Fed the space to climb down its tightening agenda. It'll ultimately wind up doing it before it's solved inflation. But with the S&P at 3,000 or 2,800 or 2,500, at some point, we're going to take down the wealth effect enough to break the heat on inflation expectations. That will allow the Fed the room to pivot. So that's where I think that's where we're going to, so I think this discussion of where the ultimate terminal rate is an interesting analytical exercise, but I don't think we're going to ultimately just kind of keep stepping up 25 basis points every month until we get to some point. Something will break first, and that's how accidents happen. That's how the Fed ultimately acts, is that they tighten to break something and then they come and clean up the mess.
But Powell said very clearly also, we're not worried about over tightening. We have tools to fix it if we do. So that's a confidence game.
Yeah, look, and I think he still is in the camp of, we've heard this from him or from others that have said he does not want to be remembered as Arthur Burns 2.0. No one will remember him for causing a recession, over the course of the next 3 to 12 months that ultimately allows the U.S. to right-size its economy after COVID and kind of reemerge. Everyone will remember him if he doesn't solve this inflation issue. Even other members of the Fed who are becoming more dovish, whether it's Brainerd or Evans or Collins or this contingent that's concerned about the labor market or eventual recession, no one's going to remember them either. No one knows who Arthur Burns' vice chairman was. But everybody knows who Arthur Burns was, and everyone will know that Powell was unsuccessful. So his ego, I think, will force him to continue to push this until something breaks.
So this was a chart going around Twitter, and I had written that I said I think the market will continue to decline until there is clear signs that the economy is weakening, right? So we sell on the rumor of the weak economy, and then we buy on the news once we have a consensus, right, that it is in fact a weak economy. And then the Fed comes out and pivots, and traditionally it's been a really, really bad time to buy risk assets. It's been the reshort,
Yeah, you typically don't want to buy the first rate cut. You want to buy the last rate cut.
Yeah.
You don't, so the market now is looking for that pivot. It will, or that pause and then pivot. It will buy into it. Then it'll be disappointed that rates are still too high and the economy is still too weak. And then the Fed will have to cut again, and then it'll get excited about that from a lower level, and then the Fed will have to cut again, and then it'll have to cut again and again and again until it gets down to some level. Maybe is that zero again? I don't know. I don't think we're going to go back to zero. We may, but we get to some level that kind of stabilizes the economy, normalizes inflation, and then investors then can start to feel more sanguine about adding risk. But we are so far
away
from that in time that I don't see and I said, hopefully we're still doing these macro to micro sessions when we have to have that conversation.
I think it's going to be wow. But I also I still think the Fed is trapped. So I think it's just going to be kind of a zigzag, even if we get to a point where they try to pivot and risk assets go up for a very, very short period of time, I think it's going to still be a short the rip type of situation because of what you just kind of laid out. It's going to be lower for longer. And that also goes with tech. I mean, I did a big piece this weekend in my intermarket channel where, tech worries me. And I have said this before back in December of 2021 and right on down the line. And then where most people are kind of expecting finally a capitulatory low, even with this Bitcoin sell-off, they're very excited about buying Amazon, Google, Microsoft, and such. I go to my kind of, secret sauce intermarket stuff, and I put together, I'm really worried about tech. And that was before the Bitcoin fall. The collateral damage obviously is to sentiment, also in NASDAQ, because NASDAQ and crypto is extremely tightly, or Bitcoin is very tightly correlated. But even before that, there's collateral that needs to be sold, right, for the liquid stuff to cover the margin calls on the illiquid stuff.
Yeah.
So I still see danger even before today, right? I wrote about this last week. I'm really worried about tech. So I don't think we've had one wave, I call it one wave of flat, which was that 2021. 2022 was the second wave down, and I see a third wave. So I definitely don't think safe is the word I would use, just because it's cheap. The interest that I have is how it's going to correlate with the sentiment of risk taking. And I think it's going to be a while before people can really come in here and say, oh, that's a bottom. We've really been through the worst of it. I don't think we're there yet.
Yeah. Well, I mean, the crypto stuff, it touches, a lot more of traditional finance than people realize, and it's not to say that all these people or players are going to go out of business because they touch crypto, but it does affect the way that businesses are run, right? Fidelity itself has a massive crypto arm, right? They have the digital trading, they have digital asset AUM, they have all, is that going to affect how Fidelity thinks about investing or growth or, in its investment committee meetings, right? State Street is an enormous global custodian for assets. It has a huge Bitcoin custodian business. What happens to that business, right? Let alone these various banks like Silvergate or Nubank is a huge Brazilian bank that Buffett owns a lot of. It's a digital bank. So, there's a lot, look at the investor list of a lot of these companies. There's a lot of traditional hedge funds and mutual funds that own this stuff. And when assets are getting marked down to zero and there's leverage against them, it forces them to do things in the other parts of their business. So, you lose, if you have a private investment in FTX, that was $100 million, that's now zero. That may affect your ability to go and trade, in a different market. So I think that's where, we could be headed with this kind of crypto contagion.
And I have not updated. This is obviously I grabbed from Twitter as well, and it's a few days old. But the point of the matter is, I still see lower 2018 minimum highs, and we're still in a down market. So a lot of folks have become day traders intraday, or barely overnight or for a week. But we're talking much more the macro backdrop of the current you want to swim with, because it's a lot easier than swimming against. And it's very clear that the sentiment does match the charts, ratio and otherwise. Let's talk a little bit about the market and the fact that we just finished kind of a undecided day as it relates to midterm elections. What does that hold in store for us moving forward, especially end of the year? I know a lot of folks are still positioned to move above, 3,900, 3,950 in SPY, so we can have a Santa rally. Because that's seasonally strong, and 18 midterms have passed where we have had that seasonality bent. I'm on the other side of that fence, right? So I am, I don't think we're going to have it. So,
look, I mean,
what do you see?
I think
midterm political.
Yeah, you need to balance the seasonality of the midterm effect with what else is going on in the world, but most specifically, what's going on with liquidity. And so there just hasn't been, I don't think, a midterm cycle that is run commensurate with massive Fed liquidity contraction. And so I think the contraction liquidity will trump any seasonal, effect from midterms. I think there was an expectation, given the polling, that we would have a red wave. That had been definitely something that had started to creep into the market, with the idea that a red wave would be kind of permanent gridlock, probably an end to more fiscal spending anytime soon, which even though we've basically been like that anyway for 6 months, but because of Manchin, but some hope that Republicans controlling things would maybe keep inflation down, and divided government is good for stocks because nothing is done in DC. So buy risk and buy, I think that was part of what we also were seeing in the energy space, where we had a lot of upside calls and activity being bought in energy stocks on this idea that Biden has been horrible for the energy sector, and the Republicans in charge, they'll unwind some of the bad policies that the Biden administration has had towards energy, which have been bad. Not realizing that Biden being bad for the energy sector he's actually been terrific for energy stocks. So I think it's probably pretty sure the energy space has been the best performing space under the Biden administration out of any space.
Since like 2001.
So, this idea, it's a little bit more like.
And that's not a political statement. That's just, we've had a phenomenal run.
Part of me thinks it's better to have traveled than to arrive, right? And so you get to a point where now we have maybe more Republicans controlling things. They open up drilling. That's bad for the energy space. So whatever, we don't need to necessarily get there. But I think, there's still some uncertainty on what's going to happen here in the U.S. I mean, it looks to me like the Democrats are going to, they're going to hold the Senate with this runoff that's going to happen in Georgia next month, which will allow them to, keep the Senate. But that does nothing. And then with respect to the House, this idea that the Republicans were going to pick up 25, 30, 50 seats, whatever, some ridiculous number, and it was kind of an anti-Biden agenda, that just didn't happen. And so, and there's still, 15 to 20% chance, given all the races that are still open, that Democrats actually can hold the House, which is crazy. But regardless, McCarthy will, as a speaker, would have a much less, has much less control over the agenda when he's only, up by 3, 5, 6, 7 seats. And so all the committees will be much tighter. So look, I think the election and politics and government specifically hasn't really been doing anything for the market in the last few months. And I don't expect it to really be much of a driver either way in the next few months. The only thing that we kind of need to think about is the debt ceiling, which is an object for the end of the first quarter in 2023. So we got some time to think about that. But yeah, this idea that politics will trump net liquidity, I think you put that chart up before. There's a significant amount of liquidity that will be contracting from the system between now and the end of the year. The Treasury general account is the biggest driver of that. It seems like Treasury has drawn down the Treasury general account, which puts money into the markets and into banks. They did that kind of for the last 6 weeks running into the election. I'm not a conspiracy theorist, but it was reasonable timing there.
Talking about this?
No, yeah, so that's it's kind of hard to see it, but if you look
this
at
is Treasury general account.
Right, you see the little bump up right before right before it goes to shade.
Oh yeah.
So that it's small on the chart, but that was $150 billion, $175 billion in the last 6 weeks that was injected into the market.
Yeah.
Based on what Treasury has said they want the year-end cash position to be, that $175 billion is going to come right back out. So that's $20 billion a week between now and the end of the year that will be extracted from the market. And then you have quantitative tightening, which is another kind of 90 billion or so this month and next month. So, it's 180 there and 175 from Treasury is 355 billion of liquidity contraction. That could be offset by the reverse repo facility being drawn down, but in a risk off setting and into year end, typically banks will want to just keep that money at the Fed overnight. So we could just see a further significant reduction in reserves across the board and the Fed's balance sheet reducing its size, which based on these charts of correlation, could intimate an S&P down kind of in the 3,300 zone by the end of the year or certainly early in the first quarter.
And that chart that I had just shown that you also sent was this support, obviously, for the energy rotation, but all things value, right? So this is definitely the growth to value or momentum to anti-momentum, or otherwise the high beta, high IV rotation to the low beta, low IV plays that have just been gorgeous for us. for like literally 2 years, but especially the last year, right?
Yeah.
So November 2020, I showed that chart, obviously, of energy outperforming, since in the last 2 years, but it's really taken off since November of 2021. Anyway, so this has been a stellar reason to avoid growth plays or tech plays. Lots and lots and lots and lots of alpha to be made in low beta.
Right.
But it was interesting to me that there are a lot of tech folks that really don't want to deal with oil and gas or cyclical plays. They're boring.
Yeah.
And no question, but they're also strength begets strength. So it has been an absolute outperformance for us when it comes to spying this rotation and this macro backdrop into higher levels. Having said that, I think they're right now, as I mentioned a few days ago, I think we're going to have some volatility because only so far can this rotation move before the diamonds, which are heavily weighted with value plays and such, start to succumb to some pullback. Right, they've been leading. So, and in lieu of sector rotation, in other words, if they're not going to growth plays, tech, and energy's tired, and the defense, it doesn't mean they're done going up, but there's definitely, I think, reason for some volatility to kick in.
Yeah, I think that chart, which would say this is not typically a great time to initiate positions that are long value, short growth.
Yes.
We've come very far in that trade. We're above 3 standard deviations. The more likely that will happen is we will get a little bit of an unwind of this trade. We did get that today, right? NASDAQ is down 2.3% and XOP was down 6.5%, right? So, but the question then becomes, do you actually want to own growth or do you want to just kind of sell value? And another phrase I like to use is alpha unwind begets beta faceplant. And so as we unwind this growth versus value trade, short term here, maybe for a couple of days or weeks to kind of reset it, that's typically going to be a pain trade. It's likely going to be more of a risk off type of trade, which is to your point, which is kind of, if you're not getting the growth to value rotation, you're going to get volatility, which in volatility going up will take us, kind of down in a more correlated, a beta faceplant, basically, in a highly correlated way. So I think if this move continues tomorrow and into the end of the week with energy falling, that's pain for folks.
And this is very much in the oil and gas play. So I'll just kind of bring these over as well. Hopefully we can see. All right. So in the oil patch, right, this I'm using crude. We came down to that 75, 76, actually 75, 77 area was my short price target. It hit 76.25 and then bounced up strongly. And it does have a look of trying to move. This was a few days ago, but the point is it's still, trying to get over resistance of this kind of 93.5 area. So we do still have potential for higher oil, but not right now. This is a perfect setup where, there were so many calls bought into this midterm election, expecting a GOP sweep, that it made perfect sense for market makers to, take these out of their hands, but also just the fact that we are not, we haven't discussed SPR, but the drama in that particular space is very much, I know folks who are very focused on lack of demand, also lack of supply, what to do about oil. But for me, it's a rates trade. Everything's a rates trade for me. As long as yields are moving higher, this will stay under control. It also has the invisible hand of government intervention, not so invisible anymore with the SPR releases. But once that it kind of exhausts itself, should yields actually do come back down, whether it's a deflation risk or what have you, I actually see the dollar and oil as a release valve higher. So I watch them very, very closely with the dollar yen. And for right now, we're kind of having this sideways digestion period for oil, but it doesn't mean we're out of the woods. We still have a risk of much higher oil into the new year. But for right now, it's seemingly suppressed with SPR and other, intervention moves. Any comments on that?
I think the SPR has been kind of, highly political in a way, but it's also been kind of in our strategic interest because keeping oil down has had the dual benefit of keeping inflation in America down, but it has also helped our allies in the UK, in Europe, and in Japan, keeping their inflation down, which has prevented or helped prevent them from selling US treasuries in order to raise dollars to buy more expensive oil. So we've kind of used the SPR as a release valve to keep oil down, but also to keep yields lower than they otherwise would have been. So there is a concern that I have that at the end of the SPR selling, which I mean, you could argue it's now, right? Like, what is the impetus now? The election is over. The government's not going to continue this plan for very much longer. If that starts to happen, oil starts to rally again, we could be in a situation where oil rises with yields going up.
Yeah.
As it becomes more expensive for overseas buyers again, and they need to sell treasuries to raise dollars to buy oil. So it'll be interesting, to see. My sense is the SPR releases are going to slow down materially, here. And if Republicans are in control, certainly I think there will be more of an impetus for that to stop too.
What about gold? That's a question I'm seeing in chat, so we need to kind of also kind of address some of those questions.
Yep.
Before we get too far off, but away from our time frame, I should say. I don't want to do more than a power hour. Time for gold, silver mining. What's your view?
Yeah, I've been, last couple calls here, I've been trying to. I own gold calls because I think ultimately, at some point, the Fed will need to bring back and add liquidity to the system, and gold will anticipate that eventual liquidity release. Gold also has the ancillary benefit of being a neutral reserve asset, which in a world that we have now where enemies like Russia and China and maybe even some other our allies who are moving towards the east don't want to own dollars anymore, don't want to own US treasuries, but want a neutral reserve asset, and gold becoming a bigger part of that. Again, Russia wants to transact in gold. Emerging market central banks have been buying more gold and holding less treasuries. The confiscation of Russia reserves probably accelerated that. So I think gold has a lot. And then today, or the last couple of days, with the crypto unwind, people who had been thinking about Bitcoin as a store of value for fixed supply in a world of fiat printing may just say, you know what, it's too complicated, but I still like that thesis. I want to own gold. So gold has a lot going for it. Gold, I think, is held in reasonably well despite a very strong move higher in real rates over the course of the last 12 to 18 months. So you could argue if and when real rates actually start to come down again, that's when gold would start to really shine. Gold in non-dollar currencies, right? Gold in euros, gold in yen is done much better because the dollar has been so much stronger. So gold's kind of doing what it's supposed to do. And I still own it. I think gold makes a lot of sense. I think gold calls make a lot of sense. The timing remains tough, but because you just never really, you never really know how far the Fed is going to take this or not. But I think you do want to own that as part of a portfolio, particularly as a portfolio like mine, which is more weighted towards being long dollar. Gold provides a nice hedge against that exposure.
And Rithika just said gold, not yet. But I still have the correlation where gold is traveling lower with yen and bonds, and the dollar yen is still flirting with higher, even though it came drastically down from that 152 area down to 145, all contrived, right? Bank of Japan intervention on October 21st. And that helped, yen pop, bonds stop falling, and also for gold to catch a bid. But I'm not convinced that that's done. So for me, it's very much an intermarket play where it says we have time to base And then when the dollar yen is done going up for real, in other words, maybe we have a parabolic spike higher into that 165, but when it actually does roll over for good, then I think gold is going to take off like a rocket. And I don't think right now the dollar yen at 145 is done going up. So it's very hard for me to get excited about gold. I know the real rates, correlation. Rithika saying, just said gold bulls, not yet. When everything goes to 100% correlation, so will gold initially. So for me, I still have my tells, right? So there's trading on a chase, swing, and trend time frame, and I still don't see a trend reversal for gold. No. But we, like you said, getting calls even back in March. I mean, not back in the past few weeks, getting calls further out in time has still paid pretty well just for this initial pop the past few weeks. So holding those make a lot of sense to me.
Yeah.
Another question, which was, what about Russia, Ukraine? What if there is a ceasefire? What are the odds? We kind of got through midterms, so to speak, as far as that politicizing of oil and SPR release. What about the pulling troops out of Ukraine? There's a lot of rumor, but there's also, some tactical moves I'm not following closely enough. But how does that impact actual positioning for the market versus just the speculative FOMO hope that China will reopen or that Russia will step down?
Yeah, it seems like the market has become kind of numb to the Russia-Ukraine situation in a lot of ways. Like we don't really talk about it much when there's these rumors that Russia's pulling out or Putin's getting peaceful. We have short rallies, but they don't typically, kind of go anywhere. I suspect, if and when that announcement is finally made, we'll have a relief rally on that for risk, and I suspect oil would fall and we'd have a shift of value to growth on that, kind of almost like the opposite of what we got in maybe the Pfizer vaccine news, right, which was a shift from growth to value. I think the end of the war would be a shift from value to growth because, inflation would be thought to come down. There'd be this idea that the energy would flow more rationally. There is no deglobalized world.
And oil will drop like a rock to 65.
Right. So, but playing for that is very difficult. Putin's not going to the G20 next week. I don't get the sense that he's moving out of Ukraine anytime soon, and I don't get the sense that he's looking to sell his energy in U.S. dollars anytime soon. So it seems like we're at a little bit of a stalemate there. December 5th, I think, is when all the allies are going to stop or going to try to do this price cap. I don't think it's going to work, but I suspect the day that goes into play, Putin's going to make an announcement or he's going to bomb something or do something that jacks the oil price up. So we may want to look at that day in around that date for oil upside, possibly just to kind of be there in case something,
Bob has a similar view. Right, our oil trader who just does oil says it's always good to have a lotto long, but the call mania that was going on, the chart that I showed into the midterm elections obviously is a little bit, I think this is space it out next year. But in any case, speaking of oil related, solar, getting a question, any views on the solar sector?
I don't really have big views there. Clearly, they were up today, I think, on relief from the sector that there was no red wave. And so if there's no red wave, that means that there's, renewable fuels are still core strategy for the administration. And so there was some relief there. The stocks they've been incredible. I don't really have much to say. I'm not really sure.
And housing, this obviously I talk about this and write about this on occasion as well, but what's your view of rising rates and the impact in housing?
Yeah, I think housing is going to continue to grind to a very sizable halt in activity as we try to find a price level that supply and demand start to meet. I mean, the national housing price indexes are all materially higher than we were pre-COVID. I mean, many asset classes now are falling below pre-COVID levels. I mean, and we've had various growth stocks and various other emerging markets that are, below where they were in February of 2020. Housing is materially above that. And it's not really clear that it needs to be in a world of 7% mortgages. It's just not, that the unaffordability issue is there. So I think we're going to go and grind to a halt basically on activity. And over the next few months, we'll start to see how distressed home builders become, how quickly they want to move their inventory. Do people need to start selling their homes because they can't afford to live in them? And that will start, do millennials start to buy homes with cash because they've been waiting for years for good prices? So housing to me doesn't seem like, housing doesn't seem like a great sector to be in. I think, home remodeling, maybe that does a little bit better as people are saying, you know what, I have a 3% mortgage, I can't leave. I'm not moving anywhere, but I like my home. I could do some work in it and, spend some money kind of fixing things up.
Continuation of the COVID stay at home. Housing definitely matters. We lost already collectively 1.3 trillion or 7.6% of their equity during third quarter alone. But I have a little bit different, like you just mentioned, folks are staying put. In other words, folks who can sell don't need to, don't want to. There's, also less work from office, but lots of hybrid going on. So they've got more flexibility in their work-life balance. But also the rate lock situation where it's not going lower. So those who are in the real estate business are that are selling are the investors, because 25% of single family homes is estimated to be owned by publicly traded companies. So those are the ones that they can discount prices, but still that cost of materials and labor is all inflationary, which is keeping the housing market relatively still supported. Yeah. So that's another reason why I follow a great housing analyst, Logan Mohtashami, who basically in June said the housing recession is upon us. We got sales are down, production down, jobs are lost, incomes are lost. It's not the same for the economy, but it's not all lost because we still have low inventory and strong inflation and basically still, for the most part, balance sheets that are still doing pretty well. So definitely a must follow if you're into the housing market, depending on your time frame, obviously. And then just speaking of time frame, we just hit 1 o'clock. So I want to thank you all for coming. 1 o'clock, 1 hour. I want to thank you so much for coming to this macro to micro power hour. I have one question that was asked in chat. Do you think we've had the lows for the S&P this year or not? Place your bets.
What I'll say is I think there is heightened risk that we take out. I think there's a heightened risk that we take out the lows, but it needs to happen imminently. And I think we are setting up the possibility that we could have that kind of event situation with what's going on right now in crypto, with the CPI print tomorrow, and with this zero data expiry kind of obsession. The market right now is not properly hedged for significant downside, anymore, right? We don't have those deep out of the money puts. Call skew is out of whack. I mean, so deep out of the money puts are actually cheap versus where maybe they were 4 and 8 and 12 weeks ago. So if we get a situation where we have some contagion continuing to brew tomorrow, Friday into the weekend, commensurate with a hot CPI print without a lot of hedging, we could get a massive amount of just, put buying all day tomorrow, all day Friday, and just dealers have to dynamically hedge, and that creates this, kind of self-fulfilling prophecy. If we don't get that, then, next few days or so, what I think will happen is vol will just kind of get compressed. This crypto stuff will go away. There'll be some hope, the Santa rally will start up again, and maybe just kind of grind higher, or this range fast without very many catalysts left for the rest of the year. Buybacks will be in place, offsetting some of the liquidity contraction. But I think we walk into 2023 with a lot of trouble.
Well, I honestly have been surprised that first and foremost, when I made the call at the beginning of the year that there would be NASDAQ underperformance and this value rotation would continue, I had a 3,800 for SPX and we hit it. And then we bounced and then we went through it. So, early at the beginning of the year, I really thought 3,800 was a reasonable level. And then I had to readjust. Okay, now 3,400 or 33 was basically the line where I was looking at for next year. And we've already come really darn close. So the fact that the crypto implosion and this continued FX volatility and treasury volatility, I still see bonds as a short. To 85, which I've talked about for TLT, ZB still looks a mess. I still see everything as a rates trade, right? From oil to the dollar to tech to value. I see everything in the light of a rates trade. So as long as yields stay sticky to higher, I absolutely believe the market will continue to roll over and head lower. So I don't have a particular price point anymore. I've been asked that because I, got that at the beginning of the year and we already hit it. So I honestly, you couldn't pay me to pick an absolute price target for year end. But yeah, I think that the market is finally, after this very strong advance in the diamonds, now I think in lieu of rotation, there will be volatility. This is a perfect time to start having some volatility, whether it's CPI, related or not. I just think that the market structure and the volume, the cumulative volume and the breadth, everything to me says still NASDAQ is in a massive bear, in a bear market, not rally. And any rally is to be sold. And until my intermarket shows otherwise, and unfortunately, I think it's going to be another year or two before we're done going down in tech. So I don't think anything else is really going to be a solid bet in tech until then. So I'm definitely bearish. All right. Again, thank you everyone for coming. And if you are interested in finding out more, you've got Fishing Club is my service. We also have Macro Advisor Bundle where you get Craig if you want more concierge service, which is really customized presence from Craig for any size investor. But definitely this is intense, a customized macro analysis as well as bespoke research as well as trade support. Definitely check us out. This is right underneath here on Macro Advisor and Macro Advisor Edge. So I want to thank everyone for joining. Have a great rest of the week. We'll see what happens tomorrow with CPI. We'll be live in the trading room tomorrow from 9 to 1. And then we'll see you on Twitter. You can find both of us on Twitter. And you got a funky little Twitter handle. Can you share that? Mine's really simple, at Samantha LaDuc. Mine is CES921, which is my initials and my birthday. So. Oh, awesome. All right. So greetings, good luck, everyone, for the rest of the week. And we'll catch you in a few weeks. Bye. Bye-bye.